Okay, so we left off Wednesday talking about the most important framework in accounting, the basis upon which the whole rest of the class is going to be built on, which is the accounting equation. Okay, assets equals liability plus equity. Why don't we all say it together? Because this is the main thing. Assets equals liabilities plus equity. Okay, uh, these terms are important. I think we did the example with the house, right? Very simple example where there are two transactions that happened. One is that we bought the house, and then the second one is that we sold the house and converted that house asset into cash, which is another type of asset. And we saw how this framework captures how much we borrowed, how much we put in of our down payment, how much of it was in the case where the house went up, how the owner, let's say I was buying the house, I benefited from that in terms of like an extra amount that I earned. Um, and when the loss happened, how I, as the owner, suffered. Okay. So again, assets, what are they? In the context of a business, they're all the things that the company owns or has rights to that will give it a present or future benefit. Okay. So we talked about a number of these. Cash is the king asset, queen asset. It's the most important one because it can be converted into any other asset. You can buy a house, you can buy equipment, you can also pay expenses, right? If you have to pay your workers, you can't pay them in, a van or like if you have tools, you can't give them a hammer. You have to pay them with cash. Okay, so cash is the main operating asset of all businesses, I would say. There's probably some exceptions, but in general, cash is going to be the most important asset. Inventory. So if you're like a retailer, Costco, they have a bunch of goods that are sitting in their stores. Those are assets because when someone buys them, Costco is going to they're going to generate revenue. We're going to talk about the specific, we've used the word revenue. We'll talk about what that is. Um, Property, plant, and equipment. Again, these are like factories, vans, vehicles, machinery, all that kind of stuff. And then we talked about intangible assets too, copyrights, trademarks, um, patents. These are all things that don't have a physical existence, but they are valuable. Okay, network effect, right? We talked about Instagram, where when they were bought out for $1 billion, it was mostly for intangible assets that it had. It was not for the computer equipment and whatever the office furniture that Instagram had. It was for this intangible asset of its user network and its product or whatever it was. Okay, so oftentimes intangible assets are the most valuable assets a company has. Okay, but we don't know the value of them until there's a transaction, until, in the case of Instagram, till Meta said, hey, I'm going to pay $1 billion for this company. And therefore, maybe they had real assets, equipment and all that of $1 million. And the rest of that billion, 999 million, whatever, is the worth of the intangible asset. Okay. If it had been $2 billion that they bought it out for, that intangible asset would have been worth 1.99 billion, right? So that the transaction price put a definitive value on that asset. Okay. Okay. So that's the left side of the equation, assets. The right side of the equation is the financing side. How were those assets paid for? Okay. And there's two ways that happens. There's through borrowing. Okay. These are liabilities. That's financing through borrowing from others. Okay. So when we say assets equals liabilities on on a company's kind of in that balance of their equation, the liabilities are going to be all their borrowings. It's not, we think about borrowing is like borrowing from a bank where you borrow money, right? But a company borrows in many, many different ways. Okay. when a worker works for 2 weeks. There are some jobs where I guess you get paid out daily, but what's like kind of the pay schedule for most workers? Biweekly, right? So for 2 weeks, the worker is actually, you're lending your employer your labor for 2 weeks. You're giving it for free, right? They're owing you those wages, and they're gonna pay you after 2 weeks. But until that time, they're borrowing your labor. Okay, so that's the liability. We would call that salaries payable, right? Um, if a company's buying inventory, the vendor may send those goods ahead of time before the company's paid them. Okay, in that case, you're going to have a account payable. You're going to have a borrowing. Essentially, you're borrowing those inventory items from your vendor. Okay, so even borrowing from your customer. We talked about one business that borrows from their customer. What business was that? Does anyone remember? Where the customer is giving, they're going to give the company money, but they haven't yet received what they're paying for. What's an example? Yeah, airlines, right? So we talked about the airlines where the customer is paying cash to Southwest. Southwest has not delivered that flight yet. So essentially, they're going to use that cash to pay their employees, to pay for fuel for their current flights at that moment. But they're going to owe you a flight in the future. So they're borrowing from you, right? You're giving an interest-free loan to Southwest or whatever airlines whenever you buy a ticket. Okay, so uh, all these where the company owes either money or services or goods or something to a third party, that is a liability for the business. Okay, any uh, clarifications needed on this? Anyone have anything that they're curious about, or a business situation where it's unclear whether something is a liability? Okay. I think the tricky ones to remember are this idea of borrowing from your customer. We're going to call that unearned revenue. Okay. Why is it unearned? It's kind of inherent in the name, but when you buy your ticket from Southwest, they're receiving payment, but they haven't earned it yet, right? We talked about that idea of revenue recognition when a company has to earn, they have to provide the good or service in order to recognize that they've kind of generated a revenue. Okay, even though they have the cash from you, they haven't yet fulfilled the second part of the transaction, which is giving the flight. So until that happens, you could always just get a refund for your flight. I mean, some flights are refundable, right? So if you paid Southwest, and you had a refundable ticket, they would actually have to pay you back if you never took the flight. Okay, so uh, that's maybe a tricky one. There's other situations like that when you hire an attorney. Has anyone ever hired an attorney or like know about how they accept payment? Will they just start working for you right away for free? What do they ask for? What is it? Retainer. Okay. A retainer is a prepayment. Okay. The attorney is like, well, I plan on doing $50,000 of work for you. Pay me 10,000 right now for the first 10,000. They haven't even started working, right? But as they work, they're going to earn that revenue. It's going to go from unearned revenue to after they've done work, they're going to actually recognize that revenue. Yeah. Have there ever been a case where the way for the lawyer used themselves? Yeah, but the lawyer technically will then have to return that money to you. They're supposed to hold it in a special kind of account where they only draw on it as they earn it. But yeah, there's definitely fraudulent cases where attorneys have collected retainers and just skipped out of town. So yeah, that definitely happens. Contractors, that's another one. In the construction trades, you got to pay your contractor up front, right, before they start working. So there's a lot of situations where this idea of your customer giving you money first before you've done anything, and that creating a liability, that happens. Okay. Um, if your company also, you can receive services, right? If your toilets at your office building get clogged up, A plumber comes, fixes it. They're just going to give you an invoice. They did the work already, but now you have a payable, right? We're going to call that an account payable. That's a type of liability. So of course we have the bank loans too. That's also a liability. When you borrow cash from the bank, you have to pay them back. So all these are the different flavors of liabilities. Okay. Um, the other way that you can finance your business, yeah.
So with the unearned revenue,
Yeah.
if someone gives you that revenue and pays you before you do the job, you pay it with your labor or you pay them back with the work?
Yeah, so you're going to pay them with your labor, right? So the attorney, they're giving you cash. The attorney's customer will give you cash, and then the way that they earn that revenue is actually doing the legal work, right? If the customer paid you and then you didn't do any work, and they're like, "Hey, actually, I have another attorney," you have to give them that money back, right? Because you haven't earned any of it. It's not your money yet, right? Make sense? Okay. Okay, so borrowing is one way of financing. The other way is the owners of the company are going to provide financing. Okay, and they do that in two distinct ways. One is called contributed capital. Okay, so right here, contributed capital. Okay, so what this means is exactly as how it sounds. It's the owners taking money from their bank account and moving it into the bank account of the business. Okay, so now the business has these funds available to spend on buying assets, paying the employees, paying the vendors. Um, in the vast majority of the cases, the way that owners contribute capital is through cash, right? You just write a check. Uh, it goes from your bank account, your personal bank account, to the business bank account, and the company then has cash available. There's other ways that owners contribute capital. I can think of one clear one in real estate partnerships. If there's someone that owns the land, right, they may, instead of contributing a dollar amount to the company, they will contribute the land. Okay, so they're transferring one asset, in the case of this real estate transaction, land, from their personal ownership to the company's ownership, and they're going to receive some stake in the company for that. Okay, now what is the problem with that? Why is that harder than, you know, let's say you have 5 different partners and they're each contributing $100 of cash. What percentage ownership is kind of like the logical way they can split it up? If each is contributing $100 and there's 5 of them, and it's the same amount that they're contributing. 20%, right? It's quite easy because the dollar amounts are fixed. You know exactly the value of what each person is contributing. What's the problem with land? Well, do you know exactly how much the land is worth? Let's say I'm one partner in a real estate partnership and the other person has the land. I'm contributing $1 million and the other person's contributing the land. How should we split up the ownership? What does it depend on? My $1 million of cash is clear, right? What about the value of the land? Is that clear? No, right? So that is, in that case, it's a negotiation, right? The owner of the land, are they going to say it's worth more or less? What's their opinion going to be? More, right? They're going to try to inflate it so that they can get a larger percentage of the partnership, right? While the other partners going to be like, no, the land is like not worth as much. So that's a negotiation that would happen when the company is formed. Okay. So oftentimes it's just easier to split up ownership when it's just cash involved. It's just it's a very easy mathematical just division. I guess one complication in that is if you have an owner, like when Mark Zuckerberg first started Facebook, he didn't contribute any money, right? He contributed the idea, his whatever. So how much of the company should he get for that, right? So that's going to also be a negotiation between those who are contributing kind of the operations and the other types of assets versus those who are contributing cash. Okay, so he would have had that negotiation with those venture capitalists who first invested with him. Okay, they would have had that negotiation. Okay, the other way that a business, the owners will pay for things, it's through the profits of the business. Okay, so as the company generates profit, it has more assets, and it's usually cash. Most businesses sell goods and services for cash. They're going to have that available to expand the business. Okay, and just like we saw with the house, when the house goes up in value, the bank is not going to get any more money, right? They lent a certain amount, and that's what they're going to get. It's the owners who benefit from the profit of the business. Okay, so any earnings, any profit that the company keeps in the company and reuses to buy more assets to kind of expand the business, that's going to be the contribution of the owners, right? Because it's not required for the owners to reinvest their profit back into the business. They can take a payment from the company back to them. What is that called? What is the term for that? It starts with a D. Dividend, right? So a company, you could set up one little ice cream shop. It has a profit of $100,000 a year. And every year, that company will distribute to the owners that full 100,000, and it can continue operating like that. However, the owners can be like, no, we want to buy a second one, right? So with the profit, that 100,000, they roll that into buying a second location, right? So this idea of taking the profits from the business and reinvesting it, that's what this second part is. This is the retained earnings, okay? And there's two parts to it. Earnings implies the profit that the company makes. Retained means how much the company is kept inside and not paid out as a dividend. Okay, so both of those things, whatever that sum is, the profit minus how much they've paid out, and that is going to equal how much they've kept in the business, right? So, um, so again, the earnings is equal to the profit. This should be an arrow, not minus. Earnings and profit are interchangeable. Okay, they're synonymous terms. What is profit? Profit is revenues minus expenses. Okay, so we'll talk in the next slide about what exactly a revenue is and what an expense is. I think we all have an intuition of what these are, right? But you can think about it as, like this company is operating to do something, to sell goods, to provide a service. So when it does this and someone pays them for that, that's going to be a revenue. Yeah, I saw someone's hand up. You have a question? Or you're stretching? Okay. Okay, and then retain, how we determine how much is retained is profit minus the dividend. Okay, so if you earned, in the case of the ice cream shop, if you had 100K in profit, but you paid 100K in dividends, that's going to have zero retained earnings. Okay, maybe you earn 100K in profit and you pay out 50K as dividends. So that means that you have 50K left over for the business to reinvest. Okay, so that 50K is going to be part of retained earnings. Okay, it's also possible, some companies do this, where they have either no profit or are at a loss, and yet they still pay a dividend. Okay, how do they do this? Well, they maybe have retained earnings from previous periods that they're able to kind of draw on. Some companies will borrow. Yeah, you can sit up here. If you want. Okay. Some companies will borrow money to pay a dividend. Okay, that's dangerous. Is that sustainable? If your company is not profitable and you're paying a dividend, what's eventually going to happen?
Bankruptcy.
Yeah, bankruptcy. You'll just run out of assets, and you're headed to bankruptcy if you're paying out a dividend that's larger than your profit. Okay, that's unsustainable. Okay. Okay. Any questions on this? Any questions? Okay. Um, okay. So just to be clear, revenues and expenses. Again, a business exists to provide goods and services. Okay. Um, Whenever that company fulfills this mission that it exists for and provides those goods and services, people will pay them for that, right? So there's different types of revenue. Okay, we have sales revenue. What do you think that's from? How do we generate sales revenue? What kind of business generates sales revenue? What is that?
Service.
Servers?
Service.
Sir, uh, well, look at the second one on the list. Okay, so what do you think sales revenue is? Source, yeah, Costco, Walmart, um, Lululemon. These are all restaurants too. Yeah, there you go, restaurants. Yes. So these are all businesses that uh, sell things, right? And people pay for them. Okay. What about service revenue? What's some examples of service revenue? Was that Expedia? What service do they provide? Yeah, they fly. Well, they're a broker, okay? They're not providing the flight, right? The airlines is providing the flight. They're providing a link between you and the airline, right? They're kind of like a middle person, okay? So yes, but they're a service provider. That brokering, linking up a buyer and a seller is a service. So yes, you're right. Um, they're not providing the flight directly, but they're providing a service.
What about professionals like doctors?
Exactly. Yes. So these are all services. A doctor is a service provider. A lawyer provides legal services. Your nail salon, you go in there, they're going to do your nails. That's a haircut. These are all services. Wedding planner, so much of our economy is actually services if you think about it. Okay. That's a very, very large part. Uh, Internet, like YouTube, these are all services. You're not getting anything physical from YouTube, right? Or Google. When you pay for Gemini, Google is providing you an AI service. Okay, so um, the service economy in America is very large. Okay, um, and more profitable. Okay, usually like Costco's margins are very low. Okay, but they just sell so many billions of dollars of stuff that they're able to make dollar amount a good like a large profit, but the margins are small. Yeah, exactly. We're gonna look at Costco's income statement at some point, but you're right. Yeah, without that membership fee, they would be like, I think it's like 50% of their profits. Yeah. Um, and it's actually like prepaid revenue. Okay, so you pay that membership up front. So this is another example of unearned revenue. Okay, Costco is giving you a 1-year membership, but they're telling you to pay up front. Okay, so they actually recognize that membership due revenue over those 12 months. And until that time has gone by, you're giving Costco a loan. So they use their membership dues to finance their business too. So it's a way for them to get an interest-free loan from their members. Okay, um, you can have interest revenue. So if your company has a lot of cash sitting around and it wants to earn something, it can lend it out, right? A business like Warren Buffett's company that has like I think $200 billion of cash that it's like kind of holding to wait for good investment opportunities, and they're probably generating interest revenue from that. Okay, it's not their main business, but the company is um, generating interest revenue. What business? Their whole thing is to generate interest revenue. What kind of businesses are those? They exist to earn interest. Who do you pay interest to? Banks. Yeah. A bank's whole business model is to lend money and earn interest. That's like their whole thing. Okay. So uh, for most businesses, it's like interest revenue is kind of it's a side hustle. Okay. But there are banks, financial companies, financing companies, their main business is to earn interest. Okay, and then rent revenue. So if you're renting out property, you could, depending on how you want to set up your books, there's some discretion here. It is a service, providing housing is providing a service, but it's you could also think of it as a separate type of revenue where you're renting out property and someone's paying you for that. Okay, um, so these are kind of some examples, and there's many other types of revenue, but um, between sales and service, it's kind of like everything is kind of like a subgroup of that, because you could argue interest is even a service, right? The bank is providing financial services to you. Okay. Um, okay, and then expenses. So any questions on revenue? Are we clear? So this is kind of like you as the owners are benefiting from this. Your company is providing goods and services, and you as the owner are like benefiting from whatever is earned from that. Okay, but you also have to pay for the expenses in order to provide those goods and services. So that's what expenses are. Um, you're going to have so many different expenses to run a business: salaries, insurance, rent, utilities, all the things that you need to generate that revenue are going to be the expenses of your business. So you're hoping that your revenues exceed your expenses, right? And that's what defines profit, right? So um, hopefully, I think that's like kind of general knowledge, right? Profit equals your how much you're earning minus your expenses, right? Everyone kind of okay with that? Makes sense? Yeah? Okay. Um, there's also other income. Okay, so for example, gain and loss on the sale of assets. Okay, so if I'm let's say New York Times. Okay, does anyone know why? What is the most famous square in New York City? Times Square. Okay, why is it called Times Square? Because back in the day, the New York Times bought a high-rise building there and made it their headquarters. Okay, um, and so that's not real estate is not a core competency of the New York Times. What is their main? What are they doing? What is their main? Uh, how do they derive revenue? What are they providing? What do they sell? Yeah, so they generate revenue from selling advertising. But yeah, they're a service provider, right? Are their customers are not paying for the advertising. Yeah, I mean, but you're right. Yeah, they're generating revenue from advertisers, but really their customers, the end customer, why the person wants to advertise there, they're providing like media services, you can say, right? They provide news, right? And by providing the news, they charge subscriptions, they can generate ad revenue, but their core thing is providing media services, right? So let's say they bought that high rise in Times Square back in the day and they sold it and they generated like $100 million of profit or some billion, it's probably in the billions. Um, that is not a core revenue, a core competency. So that gain is going to be in other income for New York Times because it's not a repeatable thing. They're not doing that every period, right? So anything that's kind of like not core, it is still benefiting the owners, okay? But we're going to see how this is all kind of listed in an income statement. You'll see it in a different section, okay? Because the investors, the readers of the financial statements want to know how much they're making from their core kind of competence versus the random stuff that happens that they are either spending money on or generating profit from. Okay, so that's kind of what this other section is. It's other random stuff that happens in the business that does generate like a revenue or an expense. But you're going to kind of have it separate because you don't want to fool the users of your financial statements to think that it's going to happen all the time. Okay, and then we talked about dividend. Okay, this is the payment from the company to distribute profit back to the owners. Okay, so actually speaking of the New York Times, the owners of the New York Times is a family. Okay, and the trust was set up generations ago, where they basically are only deriving benefit from the New York Times through the dividends that it pays. Okay, so if the New York Times company stops paying a dividend, that company can't like sell shares or anything. They'll kind of like stop. They won't have any money. Okay, so they're gonna not let the New York Times stop paying a dividend unless the company's like about to go broke, which I think happened maybe 10, 15 years ago. Okay, so but the way that that family, all the 5 generations that kind of own it, the way that they actually have money that they can buy their house in the Hamptons and stuff is through the dividend that the New York Times company pays to the shareholders, of which they have a controlling interest. Okay. Okay. So any questions on this? No. Okay. So um, this diagram is gonna remember this. This is gonna be on the quiz. Okay. You're gonna have to recreate this. Okay. Because this shows this accounting equation and all its components. Okay. So what do we have? We have assets equals liabilities, and then equity is where there's all these complications. Okay. What do we have within equity? We've talked about this, but now this diagram, I think, kind of lays it out. And I want you guys to use this as a visual kind of thing that you can memorize. Like, because this accounting equation and this schematic, it's going to be related to the financial statements. This is kind of the core of the thing. Okay. Everything that we're kind of going to do is built off of this. Okay. So within equity, we said we have 2 components: contributed capital and retained earnings. Okay. What is retained earnings? It is your profit minus dividends. Okay. So we have revenue minus expenses minus dividends. Okay. So I've just, in a diagram, just put into all the stuff I've been talking about for the last, whatever, 20, 30 minutes. Okay. So I would say be very comfortable. You can, of course, memorize this, but I want you to conceptually understand what all these different things are. Okay. Because as we're going to see, the financial statements, they're all related to this. What we're showing in the income statement, the statement of equity, the balance sheet, it's essentially just representing all this information. Okay. This is all we're really seeing. Okay. This is if you know all this information, you'll know about the company. Okay. So that's why the financial statements exist, to basically give details on this schematic. Okay. So I'm going to put up a blank one. Try to fill it in. Okay. This is going to be on the quiz. So try it now. Try it on your own. Take a minute. See if you can remember. Oh, really? Yeah, you can grab a seat here. You can just change. Uh, just try to do your best. We'll go over it together. Also, as a reminder, if you go to the Canvas page, if you go to this lecture notes, I would print these out. I'm talking through it, and if you can't see the board well, just print this out, and you'll have all the necessary stuff, and you can just add to it. Okay, so I'd print these 7 pages, and for the next chapter, print the chapter 2 stuff and bring it, because we'll start probably chapter 2 on Wednesday. So just you can prepare yourself with the pre-existing notes.
What were all those on the documents?
So if you go to the Canvas page, like this is the home page for chapter 1. It's going to be this little orange button.
Never opened it.
Okay, cool.
It just doesn't know find it.
Oh, the diagram. It's going to have the accounting equation there. Um, yeah, number 13. Yeah. Yeah, but that's
What all the different things are.
it's verbally described in the notes for sure. But yeah, you're right. Like now the test is, can you take that verbal description and kind of fill in this diagram? And we'll do it together in a second, so you'll get the answer. You can talk to your friends. I encourage that. It's not like a quiz, it's not for points. It's just for you to test your own understanding and see where you're like not remembering. And this is going to be, I'll give you a bigger hint. This will come up later in the semester because this is like this is accounting, okay? So I want you to remember this and like really understand this schematic because I'm going to show you how it's related to the financial statements and it's really like the core, a core framework, okay? What is retained earnings? What are the two words? Retained and earnings. What's the definition of earnings? Revenue. Okay. So what do you do? How do you get to earnings if you have revenues and expenses? How much profit do you have? Is it revenues plus expenses? What is the definition of profit? Yeah, revenues minus expenses. Yeah, and so that's earnings, but retained. It's like how much has the company kept for itself? Exactly. So let's say, well, I'm giving you a hint here. There's two minus signs, right? So what minus what minus what? Okay, so this is a positive. So this is going to be revenue minus. So okay, so how do you get to profit? Revenues minus what is profit? Okay, and then, so that's profit. So how much have you retained? You have to take how much profit you had minus what? Minus how much you paid in dividend. So for example, again, if you had revenue of 200,000, expenses of 100,000, that means your profit was 100,000, right? And then if you paid 100,000 in dividends, then you're gonna have zero retained earnings, right? This whole thing is retained earnings. Yeah. Well, profit and loss is just revenues minus expenses. Yeah. Yeah. Okay, so I think let's just start with the easy one. What are the top line? What's blue? Assets. Okay. What's this what is it? Salmon? Liabilities. And what's this one? This first top green one? Equity. Okay. This, at least the minimum finishing this class, you should remember this equation. Assets equals liabilities plus equity. Okay. Now you can memorize it and like know it like a parrot, but this framework we want to understand and conceptually understand it. So now, equity, what are the two components of equity? How are the two ways the owners uh, can contribute capital and help finance the business? Contributed capital is one. And if you think about it like buying a house, this is like your down payment, right? You have to take money from your bank account to invest in the house, right? It's the owner's actual capital that they're putting into the business. Okay, and what's the other one? What's the other way that owners finance the business? Retained earnings. And there's two words to this box: retained and earnings. So let's just break it down. What is earnings? What is the definition of earnings? Revenue. Okay, profit, right? So what is the definition of profit? Revenues minus expenses. So this first, we'll make these two first boxes the earnings part. Revenues minus expenses. So this is earnings. So let's put in some numbers. If I had 250K in revenue and I had 100,000 in expenses, how much profit did I make? 150K, right? Agree? Okay, so what if I paid, okay, so what is the last one? What is this? Now the retained part of it, right? So we just did earnings. Now the company can either keep this 150,000 and reinvest it in the business, or they can what? Pay it out, right? They can pay it back to the shareholders. So let's say, so this is dividends, right? We call this dividends. So in one scenario, let's say we paid no dividends. It'd be -0, right? That would make my retained earnings 150,000. I kept all of the earnings in the business because I didn't pay any dividends, right? In the other extreme example, what if I paid 150,000? Then this would be minus 150K. That's how much I paid in dividends. That would leave 0 retained earning, right? Because yes, I earned 150,000, but I retained none of it because I paid all of it out as a dividend, right? Make sense? Okay, good. Um, okay, so again, I'm gonna keep hitting on this because you know I'm telling everyone explicitly it's gonna be on the quiz, but you'll be surprised how many people just like even by the end of the class like don't get it. So maybe I gotta just hit it even harder than I have been. Okay. Um, so we'll keep revisiting this. You're gonna see how this framework is gonna appear as the basis of the financial statements, etc. Okay. Okay. So uh, this framework, well, I claimed that assets equals liabilities plus equity. This balance, this symmetry is going to exist at every moment in time for a business. After every single transaction, after every single economic event that takes place in the business, this symmetry will always hold. Okay. So we can use this framework to account for transactions. That's what we're going to be doing. That's like the whole rest of the class. Okay. So a transaction is any event that affects the financial position of the company and can be measured. Okay. So something like, your biotech company, it, it gets a drug through phase 3 approval. Okay. With the FDA. That is going to have a big effect on the prospects of the company, but it's not measurable. Okay, so it's not a transaction. It is an event for the company for sure. You're going to see the stock price go crazy, but from an accounting perspective, we cannot really do anything with that because there's no transaction that happened because we can't measure the value of that event. Okay, so there has to be this idea of measurability. There has to be a dollar amount that we can attribute, at least estimate with good faith. Okay, it doesn't necessarily have to be an exact number, but we have to have a good way, a reasonable way to measure it. Okay, in order to account for it in our accounting system. We're gonna break down assets, liabilities, and equity into accounts. Okay, so assets. What are the different accounts? Cash, buildings, land, vehicles, investments. These are all accounts that are in the subcategory of assets, right? They're all assets. They're all different types of assets. Okay, so it is feasible that you can do all the accounting for your whole business with just 3 accounts: asset, liability, equity. Okay, but if you just showed that, like if your financial statement read assets and you listed all your assets, the total was 100, and then your liabilities were 20 and your equity was 80, you wouldn't know. The financial statement reader is like, well, what are these assets? How much of it is cash? How much of it is in vehicles? How much of it is investments? You don't know. Uh, you don't know just based on this balance. The balance is holding, but you as a financial statement reader are going to want to know more details. Okay, so the way we do that is organize our assets, liabilities, and equity accounts our equity into accounts. Okay, so but theoretically you could just have these three. Okay, so we're gonna go through some transactions, and I'm gonna prove to you that this symmetry always holds. Okay, so I think it'll be easier to see this when we kind of we have some solid transactions that we're accounting for. Okay, so this first one, company sells shares of common stock to investors and raises $10 million. Okay, so my claim is that after this transaction, this uh, assets equals liabilities plus equity is going to balance. Okay, so what is happening? What are we getting? What is our company receiving in this transaction? Yeah, 10 million in cash. So is that going to go on the left side or the right side? Left, yes. So um, I'll just say assets equals 10 million. Okay. Has my liabilities increased at all? No. So this is still zero. What about equity? Yes, this is 10 million because now my contributed capital is now 10 million, right? So this balance is holding, right? 10 million on the left side equals 10 million on the right. The way that we would have this organized is we're going to now have cash 10 million equals no liabilities, and we have common stock. That's the account for this. Common stock 10 million. Okay, so now we have a little more detail. What are the accounts that were involved in this transaction? We have cash asset equals common stock, which is an equity account, and we can kind of see a little more detail of what happened. Okay, so now let's go to the next transaction. So this is going to carry forward. Okay, this balance is this is our current balance of the company. Okay, so now the next transaction happens. The company buys land for 3 million. Okay, so has anything happened on the right side of the equation? Has anything affected our liabilities or equity? Has this transaction affected either of these classes of accounts? No, we're not borrowing any money, or we're not borrowing anything, and the owners have neither made a profit, or there's no revenue, there's no expenses, they haven't contributed any more money. So this right side of the equation is unchanged. Okay, we're gonna have 0 here, and this is gonna be 10 million. Okay, what about the left side? What's happened here? What's our cash balance? It goes down, but what did we get? We got another asset, right? We just traded one asset for another. We traded cash for land, right? So this is still 10 million. The total is still 10. Okay, so how is this broken out? We have cash, 7 million, land, 3 million. And then this is the same. Common stock, I'm just going to shorthand it, 10 million. Okay, so this balance is still holding. Okay, let's go to the next one. The company provides services to its customers and bills 500,000. Okay, so what are we? This is a little tricky. What are we getting? What are we receiving? What is that? Promise to be paid. What do we call that? I think we did mention it when we talked about assets. What is accounts receivable? Okay, so on the assets, now we have cash, 7 million, land, 3 million, accounts receivable, 500K. So I'll just put 0.5 million. Okay, so now as it's a total of 10.5 million in total assets. Okay, equals, we didn't borrow anything, so the liability is still 0. We have 10 million in common stock. Okay, so right now we're not balanced, right? What part of equity is not included here? What did we just do? What was this transaction? Like what was the economic kind of reality of what happened here? We got this account receivable. What did we do? Yeah. Exactly. Yes. So we generated a revenue here, right? And as we saw in our thing here, in our schematic, within equity, we have contributed capital, that 10 million, and then revenue is also a increase. Essentially, a positive here is a positive to retained earnings, which is a positive to equity. Okay, so we now have common stock 10 million, and then we have revenue 0.5 million. So now on this side, we also have 10.5. Okay, so we still are balanced. Does everyone see this pattern? Yes, it's starting to make sense a little bit. Okay, so let's do this next one. The company pays salaries to its employees of 300,000. Okay, so uh, what did we pay with? Cash, right? So our cash, our assets are going to go down. Agreed? Okay, so we'll have cash. We had 7, but we just paid out 300,000. So it's like 6.7 million. We have our land of 3 million. We have accounts receivable, 500K, so 0.5 million. And yeah, that's it. So now we're back down to, what is this? 9.7, just reduce this, so 10.2, right? Agreed? Okay, equals 0, nothing on the liability. We still have common stock, 10 million. But now we have revenue, 0.5 million. But now we have a negative amount. Okay, so we saw here contributed capital, this increases equity. Revenues increases equity. But these two, expenses and dividends, they are decreases to equity. Okay, they're reducing equity. Okay, so we have now expenses. This is negative 0.3 million. And so on this side, we now also have 10.2 million. So we still are balanced. Okay. Transaction 5, the customer pays the company for those services, right? So we have that account receivable that was created. Now that customer is going to pay us off. What are they going to give us? Cash, right? Okay, so our cash is going to go up by 500,000. So we're going to have cash of 7.2 cash. Our land is 3. What about this account receivable? Do I still have it? No, they paid us off, right? So that account receivable represented an amount that that company was going to pay us in the future. And when they actually do it, they no longer owe us any money. It's no longer an asset for us. We just converted the account receivable asset into cash, right? So this kind of goes away. So our accounts receivable is 0 now. So we're still at 10.2. And nothing really changed on this side. Okay, so this is still 10.2 also. All this stuff is 10.2. So we're still balanced. Okay, everyone get that? Everyone cool with that? Okay? Okay, so now the company purchases equipment using a loan from the bank. So now we're gonna like mix it up here. Okay, so we're gonna get equipment, which is what? Is that on the left side or the right side? What is equipment? It's left side. It's an asset, right? So we have cash 7.2. We have land 3, and then we have equipment that we're now having $1 million. It's equipment. Okay, so now we have 11.2. in total assets. Liabilities, we just have a new one, right? We just added 1 million in liabilities because we financed the equipment with a liability, right? So we now owe the bank this $1 million. We got something for it. We got this asset, but we now have a liability of 1 million. All the rest of this stuff is the same. Nothing's changed here. Okay, so we still have 10.2 million in equity. So this is also equal to 11.2. Okay, that's it. Okay, so everyone cool with this pattern? We're now gonna do a problem. I'm gonna set you free, and you're gonna have to take a bunch of transactions and basically put them in the right place, and make sure that this balance, like, I need you to be convinced that this is the case. After every transaction, this is always going to hold true. Okay, so now, we're going to do a practice problem where you're going to get to do this. Okay, so it's maybe easy watching me do it, but now you can see if you can make it work yourself. Okay, so if you go again to this in-class Excel sheet, you guys can open that up. Yeah, or you can work with your neighbor too. Yeah. Okay, so if you open the chapter 1, it's going to be this first tab, 1-51B. Okay, so what this is a number of transactions. Just like I just showed you, like 7 of them. You're going to have all these different dates, all these transactions, and it has a spreadsheet of all the different accounts that are involved. Okay, so you're going to have to plug in, so we can do this first one together. Received 30,000 cash from MERS in exchange for common stock. So what I'll do is put 30,000 here for cash, and it was for common stock. So I can look here in my equity, contributed capital, 30,000. Okay. So I'm actually going to do this one is a little tricky to do in my lab. So I'm going to open that up, but you can get started. Okay. So you can work with your neighbors. Try to do as many. I will, like, in a couple minutes, I will do the first couple, and then we'll just keep working like that. Yeah. 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 So they've given you all the accounts you're going to need to do all of it. Yeah. Yeah. No. So look, you're not turning this in, but there is a homework question that's like this exact same thing. Okay. So if you do it in class, you understand what's going on. When you do the homework, you're going to, like, be totally set. Yeah. Yeah. No, I think just pay attention, really. Like, if you're like clear on how to do it, you'll be ready to do the homework. Yeah. Okay.
Eyesight's really bad. I see what you were writing. Could I take a picture of like the practice problems you did?
Yeah, sure.
Thank you. Wow, that's really far back screen there.
Where am I? Right here. Oh, okay.
Thank you so much.
And my handwriting is like my bad. So, which one is
It's
you?
just this is so tiny. Could I take a picture of all?
Yeah, for sure. You can just scroll up and down as you need.
Thank you.
And if you have questions, just raise your hand. I can come help you or clarify. Let me just.
How do I open the Excel sheet? Because it doesn't let me type into it.
Yeah, because
So
it's not. It's like a preview, so you can download it here.
yeah, I downloaded it.
Yeah.
It's not opening.
Do you have Excel installed on your computer?
Let me
Yeah, try to if you run it off the web, you should still be able to open that file. But yeah, I would download it. It's just easier to use if it's like on your computer. Yeah, and there if you search like DVC Microsoft Office,
Mhm.
there's like a way that you can download it and it's for free.
You can go through Insight. There's a tab on Insight for free Microsoft.
Sorry.
Can I scroll back to one other slide from before?
Yeah,
Okay.
go for it.
No, something like
Yeah, so I know there's like some kinks to work out to figure out how to get the Excel sheet to open. So if you have trouble with that, raise your hand. I can try to help you. MacBooks, gosh, sometimes it's I don't know exactly how to do it with the MacBook because I think there's different.
yeah. Open.
Um, yeah, so close this. Okay, so you have to hit this. See that enable editing? Hit that.
Enable editing.
Yeah. So
Okay.
now you can actually change the spreadsheet.
Okay.
Yeah, and it's this time the red one.
the red one that I go to. Okay.
Yeah. Yeah. Okay, first one looks right. Let me see the second one. See $4,000. Yeah. Service revenue. Gosh. Oh, that's right. Yeah, keep going. Yeah, yeah, I'll be there in just a second. Okay, so I think most of you are getting this. I wanted to show you this on MyLab because it's a little weird. And even on the Excel sheet, it's a little weird of how they formatted it. So let's just do the first couple together. So it's asking me on December 1st, what transaction happened? It was this $30,000 cash. And then we saw that is in this contributed capital, 30,000. Okay. And for those of you who haven't started using MyLab, like this is like I guess a good little intro of how it works. So I'm gonna check the answer. If I did not get it right, I have 2 more tries to change whatever my input was to get it right. So you have 3 tries per like click of that check answer thing. Okay. So that's kind of how it works. So it gives you a little bit of grace to figure out what the right answer is. Yeah. No, it just puts what the right answer is, and then it moves you to the next part. Yeah. Okay. So now it's not asking for the balances yet because we just did one transaction, right? So whatever the balances are from that one transaction, that's like balance. Okay. So and we can see it's balanced. The assets, which are the cash, accounts receivable, and supplies, 30,000 is equal to common stock, which is on the right side. Okay. So next. Received 4,000 cash. That's one account from customers for services performed. So these 2 words I need to clue into and realize that what it's saying is that this is revenue. Okay, service revenue. I've done something and I've earned money for it and they're paying me in cash. Okay, so my cash balance is going to go up 4,000 and my service revenue is going up 4,000. Okay, so I don't have to put, it's the next line where I put the balances for everything. Okay, this line for December 2nd is just this one transaction. What happened? What accounts were involved? Now I'm going to put the balance because I had the 30,000 in cash from before plus this new 4,000 from this transaction. So my total is 34,000. And this is the weird thing. Everyone pay attention, okay? Because you're going to maybe get this wrong. It's like so unobvious. So that's why I'm doing it on MyLab. You have to put zeros for all this other stuff, okay? This is 30,000. Okay, so you don't have to put zeros here on the December 2nd line for the transaction, but when you put the balances, you have to put zeros for everything that has a zero balance. Is everyone clear on that? Okay. Okay, so next transaction. I paid $100 cash. So look, this is like good SAT, like reading comprehension kind of test here. You have to read this stuff and it's telling you exactly what accounts are involved. Okay. I paid $100 cash for supplies. So there's two accounts that are like explicitly mentioned here, cash and supplies. And it's giving you the amount, $100. So what is happening is that my supplies, this is increasing. I'm getting $100 of supplies and I'm paying $100. So you have to put a negative sign, okay? In chapter 2, we're going to start learning about debits and credits. You'll never see a negative sign again, okay? But until we get there, we're going to just use negative signs, okay? Because it gets too confusing with negatives and positives. We have this system of debits and credits, which we're going to introduce next chapter, that's going to solve this ambiguity, okay? But for now, for this problem, we're going to use negative signs. So this is going to be 33,900 is the balance of cash. We now have a balance for supplies. All the rest of this is the same. And you can still see that the equation is balanced, right? We have total assets, 34,000, right? This 33,900 of cash plus $100 of supplies. And then on the right side of the equation, we also have 34,000. This revenue, 4,000, and the common stock, 4,000. Okay, December 9th. I'll do one more and you guys can keep working. Perform services for a customer and bill the customer for services rendered 3,000. Okay, so again, that's going to be a revenue. We perform services 3,000. They're not paying us yet, so it's not cash. What is the account that's going to increase from this? On receivables. Okay, so we have this account receivable. It's going up 3,000. So now when I do the balances, oops. Oh, something's missing. Okay, so now you can kind of see what happens when you get something wrong. So it's not telling me exactly what I got wrong. So anyone see it? I see it now. Yeah, exactly. Okay, so there was an existing balance in service revenue. This should be 7,000. Okay, so it's a little, look, I'm in past semesters, what it would do when you check the answers, it would lock in everything you got right and only leave what was wrong open. Okay, so this is a little harder because it left everything open. It wasn't clear what was wrong. So you will have to be a little detail oriented and understand, go through everything, figure out what you did wrong. So it's a little harder. Made the settings a little more challenging. Okay, so keep going. I'll give you guys time now to work. Keep working. Okay, so the next transaction, I think these couple are throwing people off a little bit. Okay, so you receive an invoice from PG&E, your utility provider, for $200. That means your company has used utilities worth $200 and the bill has come due. Okay, but you're not gonna write the check and subtract cash, right? So if you've used this electricity but you're not paid it off, you've technically borrowed $200, right? PG&E gave you $200 worth of electricity and you now owe them that money. So what do we call it when you owe someone something? It's a liability, right? So we're going to have the only liability they really list is accounts payable. Okay, so it could have been utilities payable. We could have called it something else, but it's essentially a liability. We have to conceptually understand here that we borrowed $200, right? PG&E gave us $200 worth of stuff, and we owe them for that. Okay, so this liability is going to go up 200. Utility expense is going to also go up technically 200. Now, how does this keep our equation balanced? Okay, so let's just see how that works. So the balances on the asset side are the same, unchanged. So we still have, what is this? 37,000 on the left-hand side. So 33,900 plus 100 is 34,000 plus 3,000. So 37,000 on the left side. On the right side, we have 200 for now our accounts payable, 30,000 of common stock, 0. We have revenue, 7,000 minus 200. Okay, so let's just make sure the math is working here. Okay, so I have 200 plus 30,000 plus 7,000 minus 200. So you can just do it. I don't have to use Excel. This $200 account payable minus this utility expense, they kind of cancel out, and we have 37,000 on the right-hand side. So our accounting equation is balanced. Assets equals liabilities plus equity. Yeah.
Since you're not in minus in front of the second 200, how it's gonna calculate this?
Well, I'm just saying, like, you can add this up. 200 plus 30,000 minus 0 plus 7,000 minus 0 minus 200 minus 0 is 37,000.
That's correct. But if we are using Excel, we don't put signs between the columns, right? So must have a minus or plus.
Yeah, but yeah, I mean, you're not necessarily doing this in Excel though. This is like in the format of this, this software. Yeah. But if you were to do it, you would do 200 plus 30,000 plus 7,000 minus 200. You would just have to, you do the calculation like this in Excel. Yeah. Okay. Okay. So does everyone understand? Really, the point of this whole exercise is to make sure you're convinced that the accounting equation is balanced at every point. Okay, so right now it's at 37,000 on both sides. Okay, the next one on the 15th, paid for advertising on social media, 125. When it says paid for, that is going to imply cash. Okay, it won't say it explicitly all the time, but you can assume that unless it says paid for on account or promised to pay or something, if it says paid for, you can assume that that means you paid for it with cash, like right away. Okay, so your cash balance is going to go down $125. In this case, I have to put a negative. Okay, again, I will repeat it. In the next chapter, we're going to learn about debits and credits. We will not use these positive and negative signs anymore. Okay, because it is confusing, as you're saying. This system is not elegant. Debits and credits is a very elegant system that will get around this problem. Okay, and then we also have advertising expense of 125. This is already a negative. Okay, so we don't have to put a negative here. This is why it's confusing. I know. Okay, so our balance here is going to be 33,775. Is that right? Someone can check my math. Okay, so if we did this math, 3,375,775 plus 3,000 plus 100, is that going to equal all this stuff added together? It will. Okay, you can do it. You can prove it to yourself if you want. But again, the accounting equation is still balanced. What we essentially had was the asset. Let me just show you kind of in one shot what kind of happened. Yes, definitely. What happened essentially is that my cash asset went down, okay, equals liability is unchanged. My equity also went down because I had an expense. So both went down by 125. Okay, that's what kept this in balance. So I'm kind of like just erasing the noise and showing you essentially what happened to our equation on a kind of high level. Okay, so again, the point of this is to really prove that the accounting equation is always balanced. Okay, December 20th, you paid the utility invoice from December 10th. So a lot of times we're going to see some transaction related to a past transaction. Okay, so you have to go back and see what happened on December 10th. We received this invoice from PG&E and we had created an account payable. Now we're going to get rid of that account payable and pay them off. So we see that our account payable balance is 200. This is going to go to zero. I know the balance is going to go to zero because we're going to pay it off. How do we get it to go to zero? This is negative 200. Our cash is going to go down 200. So we have 33,575, 3,000, 1,100. This is zero. Everything else is kind of unchanged. One key confusion is that you've already taken the expense for this. The utility expense was taken on December 10th. This is now just clearing out that payable, okay? So you're not going to have to reintroduce that expense of 200. You already did that when you first got the bill, okay? So this $200 is still $200. That's all you spent on utilities. It's just that you didn't pay it off right away. Okay. Okay, collected cash in full from customer billed on December 9th. So what happened on December 9th? We had this account receivable that was created, right? If we look back, December 9th, we had this $3,000 account receivable. We recorded the revenue because that's when we actually earned it, right? So again, the same thing. We're not going to re-record that revenue. This is just a matter of converting one asset, account receivable, to cash. We're not going to recognize any new revenue because we already did that. We've already accounted for that revenue that we provided, that service that we provided. So now it's just a matter of basically this account receivable is going to go to zero because this customer is paying us off. And we're going to increase our cash by the same amount because they've basically given us the cash. They no longer owe us any money. So our asset total is going to go unchanged. Okay, so what happened there? We had assets equals liability plus equity. Nothing happened here on the right side. We just had one asset go down and one asset go up by the exact same amount. That's why our equation is still balanced. Okay? Okay, so why don't you guys finish off the last couple? Okay, so there's 3 transactions left. Again, when we see paid for, it's going to imply cash. Okay, paid for with cash. It's not saying it explicitly, but you can, as you get used to how the textbook kind of words problems, I'll give you the kind of 411 that paid for means paid for with cash. Okay, so we're going to pay our assistant wages $1,050. So our cash is going to go up or down. Yeah. Oh yeah, but that's you can have 1,000 transactions on the same day, you know. So yeah, you're right. I skipped one. So on the 20th, let's do the rent. This first one, okay? Um, so cash is going to go up or down in this? Down, right? So negative 1,500. Yeah, thanks for pointing that out, though. Yeah, you're right. We would have gotten this wrong. I would have been confused. Okay, so we paid rent 1,500, so our cash will go down. What's the second account that's involved? Rent expense, right? Right here. And again, you're going to make this a positive number because it's subtracted here. So, okay, so what is the balance here? It's 35,075, I think. Okay. Okay, so now the second transaction on the 28th it's the same thing essentially. We paid just it's just going to be a different expense, right? It's the same conceptual transaction where we're paying cash for an expense, but it's just a different expense. It's salary expense. So we're going to do another negative 1,050 in cash. And what is it called here? Salaries expense right here, this one. So what is this? 34,025? Is that right? Oops. Okay. Received. Okay, so receive cash. So our cash is going to go up. I already know half the transaction now, or half of what we're going to do from customers for services performed. So I know that cash is going to go up 2,800. So what is it from? It's not we got a bank loan. It's not from, you know, selling some asset. It's from a revenue. We did something for a customer and we earned money. We earned that 2,800. So this is a service revenue of 2,800. Okay, so this is going to be 36,825. 36,825. Yeah. And this is 9,800. Our new total revenue for the period. Okay. And then last one, cash dividend of 2,000 were paid to stockholders. Okay, so our dividend amount is going to go up 2,000 because we now have a dividend that we're paid. What is the other account? It's the first word on here. What do we pay? Cash. So is cash going to go up or down from this? Down, right? You're taking cash from your company's bank account and you're writing a check to all your shareholders and giving them that money. So the bank account balance for your company is going to go down from this. Okay, so we're going to do negative 2,000. So now we're at 34,825. Which one is dividend? Okay, this one is dividend. Okay, so I kind of screwed up. This is, okay, so this already has a negative, so I'm just going to put 2,000. And then all the rest of the stuff is, okay, so that's it. So let's just make sure this all balances, okay? So let's see if I can do a little copy paste here. Okay, so on this, these are my assets here, okay? Asset, asset, asset. So my total assets is 100 plus this. Okay, so on the right side, let's see what we have. We have our common stock. I think this is minus the dividends plus the revenue minus all these expense accounts. Okay, and it balances, magic, okay? So through all that drama, all those transactions for the whole month, at every point in time, our equation is balanced, and at the end, we see that it is balanced, okay? It's a split between all those accounts now because we had all those different transactions happen. Okay, so is everyone a believer in assets equals liabilities plus equity? That's the goal of today, is to make you all believers. Yes? Okay, and this is like, it's not an obvious thing, okay? This symmetry that exists, it's, if you just, it's not obvious, okay? But it is amazing. I think this is like a really amazing uh, kind of, that's why this framework, assets equals liabilities plus equity, is like, it's not just, it's like, it's quite powerful, okay? And we're going to see how it also relates to how we're going to set up our financial statements, okay? So we have 9 minutes. I'm going to talk about it now briefly, and then we're going to revisit it and do a practice problem first thing Wednesday, and then we'll jump into chapter 2 on Wednesday. Okay. Yeah. I just took the balance, this last line. Yeah. We're not done, but yeah, if you gotta go, you gotta go. But I'm gonna still go for 9 more minutes. Okay. Okay, so the financial statements essentially come from this equation, okay? The name of these financial statements is actually important. At the end of the semester, I had students that didn't know the names of these. If you're gonna work in these professions, you gotta know the names of these financial statements, okay? Income statement, okay? This is basically this bottom part here. We're gonna traverse up this tree because at the end we want to prove to our financial statement readers that assets equals liabilities plus equity at the end of the period. Just like we did, I just showed you that addition of the both sides. We're gonna want to prove that to our financial statement readers. So we're gonna start with the bottom here. Revenues minus expenses. In a year, in a quarter, we're going to list all of the revenues, all the expenses, and we're going to show how much profit we made in that period. Okay, so that's going to get us part of the way to figure out what our equity balance is. Okay, so this first financial statement is called the income statement. It's just going to list all your revenues, it's going to list all your expenses, and it's going to show what your total earnings were for that period. Okay, it's usually a quarter or a year. And if it's an annual income statement, it's going to be for 12 months. If it's a quarterly income statement, it's going to show what happened in the last 3 months. Okay. So now that we have we now have our net income, as it's called. This is how much profit we earn. We now want to see what our retained earnings is, right? So we take the number that we just got from that income statement, that profit, and we see how much we paid in dividends. Okay. So we're going to have basically a retained earnings balance at the start of the year. We're going to see how much profit we generated in that year, which is this. We're going to subtract how much dividends we paid, and we're going to get an ending balance for retained earnings. Okay, so this framework is going to be, we're going to see this framework of beginning balance plus additions minus subtractions is going to give us our ending balance. Okay, so we're going to see this with inventory, right? We started with some amount of inventory, we bought more inventory, we sold some inventory, and then we have the ending balance. For retained earnings, we have a beginning balance. At the beginning of the year, we had some amount of retained earnings. We then added our net income. We're subtracting dividends, and that's going to give us our ending balance for retained earnings. Okay, so we're going to have one financial statement that's just kind of devoted to this. Okay, and that's going to show us this ending balance for retained earnings. Okay, so we're going to look at some real financial statements later, but really this statement of retained earnings is like, it's not really a real one that's presented, but for your book, because they want you to kind of step through things individually, we have the statement of retained earnings. So now we have this part of equity, okay? After this statement of retained earnings, we now have the retained earnings balance for our company, okay? Now we're going to go to the next part where we combine our retained earnings with how much contributed capital there is, and that's going to give us the total equity balance. Okay, now we have this green, we have the amount that we're going to put here. Okay, now we've gone through, we start with the profit, we added the dividend piece, we added the contributed capital piece, and now we have the total equity balance. Okay, and that there's a lot of complexity in this. But if you're like an owner of a company, that's really what you care about, right? How much your company, how much your ownership stake is worth. Okay? So this is a statement of shareholders' equity. It's going to give you basically the ending equity balance. And then the main financial statement is called the balance sheet. Okay? I see, say it with me, balance sheet. Balance sheet. Okay? The balance sheet is going to show all your assets, and it's going to show that that equals liabilities plus equity. It's going to show that this balance is maintained as of the end of the year. Okay? And we went through all the rigmarole to figure out what this balance is. Right? All those other financial statements were leading up to getting this. Once we have this, we can complete the balance sheet. Okay? So let's just look at a couple of real ones. I think it's worth looking at. Okay, last one. These are all interrelated. Okay, your income statement, revenues minus expenses gives you the net income. The net income feeds into the statement of retained earnings because you have the beginning balance plus this minus your dividends gives you this. This ending retained earnings balance is going to flow into the balance sheet. So they're all building on each other. Okay, is that clear? Okay, so now let's see this in a real company. Okay, so, oops. Okay, so this is Google, okay? So let's start at the bottom. Oops. Where did it go? Okay. So they call it the income statement. They're calling it the statement of income. Okay. It's saying the same thing though. Okay. 53. So you can see here their net income. So they have their revenues. Gosh, sorry, to zoom in, it's like changing the page. Okay, so they're listing their revenues 200 in this last year 350 billion. Okay, this is in millions of dollars, and it's for the year. It's for the entire year of 2024. So 350 billion is their revenues. They have a bunch of their expenses listed. Income tax, they step down and they basically get to their profit of $100 billion for this year. Okay. Now, if we go look at this statement of shareholders' equity, okay, you're going to have the beginning balance. So at the end of 23 is the same as the beginning of 24. Okay. So this line right here is the beginning balance. Okay. And if you look here, retained earnings right here, this column this is all of their different equity accounts. But if we just look at retained earnings, this is what their starting balance was. You can see that the net income is added in here, this 100 billion. They also paid dividends, essentially. So they have some dividends that they paid as cash. They also, and we're going to learn about this later in chapter 13, they also returned money to the shareholders by repurchasing their stock. It's essentially another form of dividend. Okay, so they have beginning balance minus their dividends, you can say, plus their net income. And this is the ending balance of retained earnings. And then they have, these class A, class B, class C. This is all contributed capital. Okay, so this statement is showing all contributed capital, retained earnings, and it's giving a final total stockholder equity ending balance here. So remember this 325 billion, okay? Because we're going to need this in our balance sheet. This is the total equity. Okay, so if we go here to the balance sheet, this is the consolidated balance sheet. So it has all their assets. They got cash, accounts receivable, where the heck did it go? Property, plant, and equipment. So they have 450 billion of assets, and they have liabilities, accounts payable, deferred revenue, which is essentially unearned revenue. They have debt. They've borrowed money. And then at the end here, we have this total equity of 325 billion. And you can see here that their total liabilities and equity, 450 billion, 256, is equal to their total assets, 450 billion, 256. Okay. So this accounting equation is represented right here. And I just stepped through it. I did it quickly, but I just wanted to show you that this is how it works, It's much more complicated. They have way more accounts. If you want to know the details, you have to read all 75 pages of this to understand the details of all these numbers. But essentially, it's all built on this framework of assets equals liabilities plus equity. That was my goal, okay, to show you. So we will pick this back up where you will get a chance to make these financial statements, and yeah, we'll wrap up chapter 1.